Hi everyone, in this video we're going to talk about the weighted average cost of capital. So just a reminder, this is for education purposes only, not for investment advice, and you should watch the video all the way through the end to really get a strong understanding of this concept, as it's critical in corporate finance. And finally, if you just go ahead and hit the like button, we really appreciate that. Post any comments or questions you have in the comment section, and any topics that don't make sense or any topics you would like to see us cover, post those in the comments as well, and we'll make those videos for you. Great. So what is the weighted average cost of capital? It's typically called WACC, and it's basically a weighted average of the cost of debt and the cost of equity. And then we'll get into this shortly, but the cost of debt, specifically the interest payments, are typically tax deductible, and so we get what's called a tax shield from using debt. Okay, the cost of debt is the interest rate on the debt, right? This is denoted R subscript D, and the interest on debt is tax deductible, so debt comes with a tax shield, and this is which is this 1 minus T, and we'll get into exactly how that works. Okay, so here's an illustrative example. Consider a company with a 10% cost of debt, which results in an interest payment of $10 million per year and an effective tax rate of 25%. The company's cost of debt is 10% times 1 minus 0.25, which is 7.5% after the tax adjustment. Okay, but we want to really get into how does that work? Like, what is this tax adjustment? Why is there a tax adjustment, etc.? So suppose the company pays $10 million per year in interest payments on the debt. That interest payment is tax deductible. So assuming the company earns $50 million per year in pre-tax profit, the $10 million would be subtracted from the $50 million. So $50 million in profits, $10 million in interest payments, right? So we have to subtract off the $10 million from the $50 million, right? Because we're adjusting for the interest payment. So now they've got $40 million in profits. Okay. Well, as a result of the $10 million deduction in the company's $50 million profit, the company then does not have to pay taxes on that $10 million in profits. And so that $10 million in profits would have resulted in a $2.5 million tax bill, given the effective tax rate of 25%. Hence, while the company is paying $10 million per year in interest payments, it is also saving $2.5 million per year in taxes. So the net cost of the debt is $7.5 million, or 7.5%. So does that make sense? We have this because the $10 million interest payment is being deducted from the profits, assuming there are enough profits to cover that $10 million, then we basically, the profits are reduced by $10 million. And because the profits are reduced by $10 million, we then save $2.5 million on the tax bill. And so that's why it's 1 minus 0.25. We're adjusting for the savings on the tax bill. Okay. Now, in terms of the cost of equity is the return shareholders need to be paid to hold a firm's equity. And so, this is a little bit theoretical because we don't actually pay this amount out to the equity holders. However, if they're not earning a good enough interest rate, they can effectively pull their cash. And so this is sort of what they need to be paid in order to remain shareholders of the business. And so that's the cost of equity, can be estimated using the CAPM. And so you can go back and look at the video from CAPM, but what CAPM basically says is that this is return on equity equals the risk-free rate, alpha, plus beta times the market return, where beta is, typically the correlation of the return on equity with the market return, and then plus epsilon t. So this right here is just the CAPM. We then weight each cost depending on how much of each we have. So, for example, we look at, okay, how much debt do we have as a percentage of our total financing? How much equity do we have as a percentage of our total financing? We then put in those weights, plug in the return on the debt, plug in the return on the equity, adjust for the tax rate here, and then that gets us the weighted average cost of capital. So if 33% of the company's financing comes from debt and 67% from equity, and the cost of equity is 15%, then the total weighted average cost of capital for the company is as follows. You can see we plug in the weight on the debt, 0.33, plug in the 0.1 cost of the debt. We adjust for the 1 minus 0.25 effective tax rate. We add 0.67, which is the weight on the equity, and then the cost of the equity is 0.15. And that gives us a weighted average cost of capital of 12.5%. And so why is this important? Why do we care about this? Well, as it turns out, the weighted average cost of capital is then basically becomes the firm's discount rate. That is how, the time value of the firm's money. And so when we're deciding whether or not to do a project, when the firm is deciding whether or not to do a project, the return on the project will be compared against the weighted average cost of capital. And so here's just a pop quiz for you. If the return on the project is 10%, should the company do the project? No, right? Because then the return on the project is less than the company's cost of capital, right? And so it'll be losing money on the project because the returns are lower than what the firm's cost of capital is. However, if the returns are 20% on the project and the firm has a weighted average cost of capital of 12.5%, should the company do the project? Yes, right? Because the cost of capital, they're basically borrowing money at 12.5% to finance the project. They're getting 20%, and the profit the firm is making is that 7.5% spread, right, between the 20% return on the project and the 12.5% cost of capital. And so in this way, the weighted average cost of capital actually becomes a super important number in corporate finance, because anytime you're going out and evaluating projects, you have to compare the return on the project, the expected return on the project, to the weighted average cost of capital, and make sure that there's a big enough spread that the company can profit off of it. Anyway, I hope you enjoyed this video, and we'll be posting more for you shortly, so keep watching the channel. We're going to do one on terminal value right now. Take care.